Hey, in this video, we'll take a deep dive into what is Balancer in crypto. If you're watching this video, you probably know a thing or two about finance, regardless if it's traditional or of the more modern kind. Thus, you know that loans are an inseparable part of the finance ecosystem. Imagine that you want to get a mortgage for a house somewhere in the suburbs. To receive the money, you have to apply to a bank, get your identity verified, have your background checked, and go through multiple steps until the money reaches your pocket, aka your bank account. It could take weeks or months before you actually buy your dream property. Although Balancer doesn't necessarily issue loans, it aims to provide financial solutions that allow crypto investors to avoid the interference of third-party or centralized authorities, creating a trustless and permissionless platform. Welcome to Crypto Finally Explained, the most crypto-friendly educational YouTube channel for actually learning crypto. Here, I finally explain crypto topics using simple animations, visual doodles, and real-life examples, so no matter if you're 5 or 75, you'll be able to understand it. In this video, we'll discuss the specifics of Balancer and crypto index funds. In particular, we will search for an answer to questions like what is Balancer in crypto, what is a crypto index fund, and what is BAL in crypto. Let's get right to it. Before we start exploring what is Balancer in crypto, I want to give you a quick heads up. The terms and concepts explored in this video are pretty complex. Thus, I recommend you watch my other animated explainers on liquidity pools, decentralized exchanges, and automated market makers to prepare you for what is coming next. Ready? Okay, let's get to it. Balancer's development started in 2018 under the research and engineering firm Block Science's wing. However, as the project grew larger in 2020, Fernando Martinelli and Mike McDonald decided to open a dedicated company, Balancer Labs. Following the launch, Balancer Labs introduced what is now known as the Ethereum-based automated market maker, decentralized exchange, and liquidity pool, Balancer. Balancer's first steps into the decentralized finance or DeFi ecosystem were led by $3 million funding. Over the years, together with a dedicated team of developers, a seemingly small budget turned Balancer into one of the top projects in the DeFi ecosystem in terms of trading volume and total value locked. Now that we know how Balancer got on the DeFi radar, it is crucial to answer perhaps the most important question: how does Balancer work in crypto? We already know that Balancer is like three musketeers covered in one name. But how does it work? Well, the terms automated market maker and decentralized exchange are inseparable parts of the same picture. In particular, there are three types of decentralized exchanges: automated market makers, order book DEXs, or DEX aggregators. In this video, we will not delve deep into the types of DEXs, but if you're interested, you can check out my detailed comparison of centralized and decentralized exchanges. Okay, back to business. As an AMM-powered decentralized exchange, Balancer essentially uses algorithms to manage crypto buy and sell orders. On the other hand, its counterparts, centralized exchanges, use a bid or ask system, also known as order books. By using algorithms, decentralized exchanges avoid the interference of third parties or centralized entities and speed up the crypto trading process. Let's look at this concept from an everyday perspective to better understand it. Imagine that you want to buy the newest iPhone that just hit the market. If we compare your purchasing journey to order books, the seller is Apple. You are the buyer. If you choose not to buy your iPhone directly from the Apple Store but from, let's say, Amazon, the latter company is your third party through which your order is going through. On the other hand, in terms of automated market makers in the real world, you would pre-order the newest iPhone directly from Apple, pay the money, and upon the release day, Apple would send you their newest phone directly from their warehouse. Now, let's get back from the world of iPhones to the world of decentralized finance, shall we? Instead of using order books with its innovative algorithm-based system, Balancer relies on its pools injected with ERC-20 standard tokens. These pools are filled with cryptocurrency and are used to provide liquidity to traders. However, the pools are not filled by Balancer. Instead, liquidity providers inject crypto into these pools. While there are many decentralized exchanges that use liquidity pools, Balancer stands tall in the number of different tokens that can be added to one pool. For example, decentralized exchanges like Uniswap or SushiSwap allow only up to 2 different cryptocurrencies in one pool. On the other hand, Balancer lets liquidity providers add from 2 to 8 different cryptocurrencies in a pool. On top of that, assets in Balancer pools can have different ratios. As other decentralized exchanges allow liquidity providers to place only 2 different assets in one pool, their ratio will always be 50-50. However, Balancer is also different in this perspective. The decentralized exchange lets users set different ratios like 80-20, 30-30-40, or 20-20-10-50, depending on how many different tokens are in the pool. What is also unique about Balancer pools is that they use smart contracts to maintain the value of the tokens inside the pool. If the price of a particular coin increases or decreases, the pool automatically adjusts the price of the tokens to maintain the ratio in that particular pool. For example, let's say the pool consists of 20% Ether, 20% Link, and 60% Tether. If, at some point, the price of Ether would increase by 50%, the pool would automatically readjust the price of Link and Tether to maintain their previous ratio in the pool. Now, to ensure that traders find the best pricing to swap their desired tokens, Balancer uses a Smart Order Router, or SOR. This system scans all of the existing pools and chooses the one that would benefit traders the most. In particular, it compares gas fees and the amount traded on the pool, bringing the pool with the best price for that trade at the front. It is worth noting that there are several types of liquidity pools that Balancer offers, including public, smart, and private pools. In this group, smart pools act as Netflix's premium plan. It still serves its primary goal of being a liquidity pool, but gives liquidity providers more control over their pool. In particular, smart pools offer liquidity providers a front seat at the control desk, allowing them to customize a range of features. The pool creator can alter what assets are exposed to the pool or what kind of fee should be taken from users who want to swap with the pool's assets. Nevertheless, pool owners can change the asset ratio and weight in a crypto index fund at any time. As with any other pool, liquidity providers can allow other traders to interact with it and use it to swap desired crypto assets. In return, the pool owner will receive the fee as a reward, which is set when the fund is initially created. Unfortunately, we don't have time to explore all types of pools on Balancer today. If you want to see a more detailed video about Balancer's pools and how they operate, leave a comment below and I might create a dedicated video on this topic. Before we move on with Balancer, we should discuss another feature that plays an important role in the protocol's ecosystem, the Crypto Index Fund. So, what is a crypto index? Let's explore this topic together. To put it short, crypto index funds are financial tools that allow users to invest in a group of cryptocurrencies with a single trade. Crypto index funds are particularly favored among investors who want to gain exposure to a diversified crypto portfolio without the desire to invest in each crypto asset separately through a centralized exchange. The majority of crypto index funds on decentralized exchanges, such as Balancer, focus on giving exposure to the top 5 or top 10 cryptocurrencies by market capitalization. However, some funds are created to offer investors exposure to more specific areas of the crypto ecosystem, such as DeFi-related digital assets. At this point, you may wonder, why would one invest in crypto index funds at all? Well, as I've just mentioned, essentially, they allow users to passively obtain access to the larger crypto market and diversified portfolio of tokens. Moreover, they're also typically considered a slightly safer choice for investing in cryptocurrencies. This is only a short overview of crypto index funds. If you want to know more about this topic, let me know in the comments below, and I might create a dedicated video on crypto index funds as well. As we've covered almost all of the focal points on what is Balancer in crypto and how does Balancer work, it's time to introduce another integral part of this project, its native token BAL. Looking into Balancer's backstory, the project started operating without its native token. However, shortly after its launch, developers decided that they wanted to create a fully decentralized environment, allowing dedicated users to have their say on the protocol's future. In other words, they wanted to create a decentralized autonomous organization, or a DAO. For more information about DAOs, check out my dedicated explainer video. After making such a decision, the Balancer team decided to introduce its native token BAL, raising the question of what is BAL in crypto. I'll give you a hint, it's not related to basketball in any way. The BAL token was issued on the Ethereum blockchain using the ERC-20 standard. As with most decentralized finance protocols, BAL mainly serves as a governance token. With the digital asset, holders can voice their opinions about certain project-related matters, like new features and token distributions. Upon launch, the developer set an issuance limit of 100 million BAL tokens. From this amount, 25% or 25 million tokens were distributed to founders, investors, and key stakeholders. 5% were donated to the ecosystem, with another 5% saved for the project's future. Following these distributions, the team decided that it would distribute the remaining 65% of BAL tokens to liquidity providers and traders over the years. In particular, Balancer has set weekly and yearly BAL token distribution limits. Every week, 145,000 BAL tokens are mined and issued to Balancer liquidity providers as a reward, making the total annual supply of BAL tokens 7.6 million. This means that, at current rates, it will take Balancer a little over 8 years to distribute all of its BAL supply. Like many other ERC-20 tokens, BAL can be purchased on major crypto exchanges like Coinbase and Binance. Balancer is definitely quite a challenging project to wrap your head around. However, I hope that this video helped you understand what is Balancer in crypto, what is a crypto index fund, and what is the BAL crypto token. Before you go, let's recap what we know now about the project. Balancer is an AMM-powered decentralized exchange with aims to offer crypto trading services without the interference of a centralized entity or third party, making it a permissionless and trustless protocol. Put simply, Balancer strives to make crypto swapping available to anyone. liquidity providers play a central role in Balancer. By depositing their assets to liquidity pools or creating their own highly customizable crypto index funds, users can earn Balancer's native token BAL and a portion of fees generated from all of the orders in the pool. So, what do you think about the Balancer protocol? Have you ever used it to swap crypto or even created a crypto index fund? Please share your answers below and let's discuss. Thank you so much for watching this video. I hope that you found it valuable. If you did, make sure to give the video a like and subscribe for more animated crypto explainers. See you next time.